Well, welcome back. Now we'll look at where markets ended the week after we did get new inflation numbers this week, a smaller than expected increase for consumer prices, rising 8.5% in the month of July. Wholesale inflation also coming in below expectations with an increase of just 9.8% for the producer price index. But we are also hearing about a surge in layoffs as the economy slows down. Joining me right now is Satori Fund founder Dan Biles to talk about the macro story and investing in it. Dan, it's great to see you this weekend. Thanks for being here.
My pleasure, Maria.
Let me get your take as a start-off point on assessing where we are right now. I mean, on the one hand, we had this big rally in stocks beginning in the middle of June until now. We're still seeing, the NASDAQ up in double digits just in that month and a half. At the same time, we got 2 quarters of contraction. How do you assess where we are right now, Dan?
Yes, that's a great question, Maria, because it's easy to get caught up in the fact that the market's rallying and you have a lot of people calling that this is the next bull market. But if you step back from it all, there's several things you know. The first one is you don't want to fight the Fed. And usually people say that in a bullish manner and that the Fed is cutting and so the markets go up, et cetera. But this time the Fed still has a lot of work left to do where rates are at 2.5%. In their summary of economic projections, they've said that's going to go to 3.25% to 3.5% at the end of this year, and then 4% by the end of next year. So you don't want to fight that. The second is you don't want to fight the fundamentals. And for the first time in 2 years during this last earnings season, you had estimates for the S&P 500 actually go down looking forward. So those are the 2 components that really make it difficult to believe that this is anything but a bear market rally within a longer-term down move.
And we've heard from a number of companies. You mentioned Micron Technology often, the fact that they had a recent negative pre-announcement 5 weeks after guiding revenues lower. We had a Walmart situation. So we've got tech, retail showing real weakness. In the upcoming week, we're going to get a read on the consumer with a number of retailers reporting earnings. You say don't fight fundamentals and don't fight the Fed. How are you investing right now?
Well, what we're doing is, on June 17th, we put out a post on social media saying we expect the next bear market rally. And so we're positioned to take advantage of that. And we've gotten that. And if you look back through history, even if you look at when Paul Volcker had to take rates up tremendously, you had 6 rallies in the S&P of averaging 8% each. This year, we've had 4 rallies averaging 9%. And this last one is obviously bigger than that, but it's within the normal move. But what you want to do is go, okay, I don't want to fight the Fed. I don't want to fight the fundamentals. And so right now what we've done is we've sold into this rally now. Now we have more shorts again than we have longs. We've raised a lot of cash where we've sold a lot of the names that have done well during this most recent bounce. And what we're anticipating, to your point, is as we get more data coming out about the consumer, and then don't forget, we have the Jackson Hole meeting of the world central bankers at the end of the month. They're going to say, we've still got a long way to go to kill off this inflation, so a lot more rate hikes. I think both of those things, the fundamentals of the consumer and what the central banks have to do, that's going to put more pressure on the market again.
I know you've got a lot of information on danniles.com, and one of the notes you have is that a recession with inflation still over 3% is our best case for 2023, with a 30% drop in the S&P 500 from current levels. Does that mean you're selling into this rally now? While also expecting mini rallies in this overall bear market going into 2023 and 24?
Absolutely. It's a great summary, Maria. I mean, we've been selling the names that have done really well during this last move up. We've gotten short again. We've raised a lot of cash. Don't forget, you look back at the global financial crisis or the tech bubble, you had 5 rallies in the S&P between 18 to 21%, and you lost half your money during both of those periods of time. So you don't want to get caught up in this latest move unless you really think we're done with inflation so the Fed can stop and the fundamentals aren't getting worse. And all the company reports you've seen kind of indicate in aggregate that demand is still slowing.
All right, we will leave it there. Dan, always a pleasure to speak with you. Thanks very much for laying it all out there. We'll keep watching. Dan Biles joining us. Thank you.